In the last module, we examined how sanctions screening works. Now we ask a more fundamental question: who owns it, who funds it, and who is accountable when it fails? Compliance does not collapse because a policy was missing. It collapses because the structure behind that policy was weak. Major regulated exchanges, with documented programs and licensed tools, still faced enforcement action. The failure was not technical. It was structural. When compliance lacks authority, independence, and ultimately board oversight, risk accumulates quietly. Before a system fails operationally, it fails architecturally. Your compliance architecture either protects the business or exposes it. Many firms say, "We have AML." But what does that actually mean? Checklist compliance usually includes three things: a written policy, a screening tool, and a nominated MLRO. Operational compliance is different. It requires funded teams, clear reporting lines, documented blocking authority, and active board oversight. Checklist compliance exists on paper. Operational compliance exists in decision-making. The difference becomes visible when revenue is sacrificed to protect the license. Having AML is not the same as having control. In most crypto firms, growth and control are measured differently. Product teams are rewarded for speed, user acquisition, and transaction volume. Compliance teams are evaluated on risk reduction, alert quality, and regulatory exposure. Those incentives are not aligned. Imagine a cross-chain swap feature ready to launch in 2 weeks. Compliance requests additional time to assess bridge-related laundering risks. Product pushes forward to protect quarterly targets. 3 months later, regulators question monitoring gaps. No one acted maliciously. The conflict was structural. When incentives diverge, risk accumulates silently. And without governance mechanisms, growth will almost always win. To manage the tension between growth and control, institutions rely on a structural model known as the 3 lines of defense. The first line of defense focuses on operational execution. Product, engineering, and operations implement controls in daily activity. The second line designs and challenges. The third line tests and reports. Compliance and risk define standards, monitor exposure, and question decisions. Internal audit independently evaluates whether the first and second lines are functioning properly. Each line has a distinct role. When the second line begins executing onboarding, or when the first line evaluates its own controls, the structure collapses. The model only works when responsibilities are separated and authority is respected. Without that separation, governance becomes self-review. And self-review is not control. Within the second line of defense, the MLRO plays a critical role. But independence is not declared. It is structurally enabled. An MLRO with a direct reporting line to the board has institutional protection. This distinction is often visualized as solid line versus dotted line reporting. A solid line to the board reinforces independence. A solid line to finance or operations creates structural tension. When risk decisions are filtered through revenue priorities, objectivity erodes. The question is not whether the MLRO is competent. The question is whether the structure allows the MLRO to act independently. Because without structural independence, compliance becomes advisory, not authoritative. Not all compliance programs operate at the same depth. Some are tick-box structures. They have policies, procedures, and periodic reviews. But controls rarely interrupt revenue. A PEP policy that never escalates a client. A sanctions policy that never delays a transaction. That is documentation. Risk-based compliance behaves differently. It tests controls. It challenges onboarding decisions. It blocks high-risk exposure when necessary. Regulators do not evaluate how polished a policy looks. They evaluate whether behavior changes when risk appears. If compliance never creates friction, it is not controlling risk. It is decorating governance. And decoration does not prevent enforcement. Structural independence is meaningless without decision power. The critical question is simple. Can compliance block a product launch? Can compliance prevent entry into a new jurisdiction? If the answer is no, compliance is advisory, not governance. Advisory functions provide opinions. Governance functions exercise authority. Blocking power does not mean compliance controls the business. It means certain risk thresholds cannot be crossed without formal approval. Without documented veto rights, high-risk decisions will default to commercial priorities. Not because of bad intent, but because revenue has momentum. Authority must be defined before it is needed. Because once a launch date is announced, resistance becomes symbolic. Blocking power alone is not enough. When product and compliance disagree, there must be a defined escalation path. Governance requires a mechanism, not improvisation. A typical structure follows 3 steps. First, the conflict is documented internally between product and the second line. Second, the issue moves to a formal escalation committee or risk forum. Third, unresolved high-risk matters are presented to the board or board risk committee. This structure protects both growth and control. It ensures decisions are recorded, challenged, and consciously accepted. Without escalation architecture, conflicts are resolved informally. An informal resolution almost always favors speed over scrutiny. Governance is not about stopping innovation. It is about deciding risk at the right level. Many firms size compliance teams the wrong way. They treat headcount as a cost decision. Compliance staffing is not an HR question. It is a risk calculation. The number of analysts required depends on exposure. Exposure to onboarding volume. Exposure to high-risk clients. Exposure to multiple jurisdictions. Exposure to complex products. A firm with 100,000 low-risk retail users is not the same as a firm with 10,000 high-risk cross-border accounts. Headcount must reflect risk intensity, not company size. When staffing is disconnected from exposure, alert backlogs grow, reviews become superficial, and risk goes unchallenged. Compliance capacity is a control variable. And control variables must be calibrated to risk. A risk-weighted sizing model starts with a simple question: how much manual risk review does your exposure generate? Step 1. Calculate onboarding volume and average review capacity per analyst. If one analyst can review 20 enhanced due diligence files per week, and you generate 100 high-risk files, you need at least 5 analysts, just for onboarding. Step 2. Calculate transaction monitoring alerts. If high-risk clients generate 3 times more alerts than standard clients, headcount must reflect that intensity. Step 3. Adjust for jurisdictional complexity and product innovation. Each new license and each new feature increases review burden. Headcount equals exposure divided by review capacity, adjusted for risk intensity. That is structural calibration. Not budgeting. Underfunding compliance is often framed as cost control. In reality, it is risk amplification. A team of 10 qualified AML analysts may cost €1 million per year. A single major enforcement action can exceed $50 million in fines, remediation, and monitoring costs. Add legal fees. Add external consultants. Add reputational damage and delayed licensing. Add potential loss of banking relationships. The financial asymmetry is obvious. Compliance spending is predictable and controllable. Enforcement spending is reactive and exponential. When firms underinvest in controls, they are not saving money. They are deferring liability. And deferred liability compounds. In regulated environments, compliance is not a management issue alone. It is a board responsibility. The board approves strategy. If strategy includes high-risk products, cross-border exposure, or rapid expansion, the board must understand the associated regulatory risk. Approval without comprehension is not oversight. It is delegation without control. Fit and proper standards increasingly evaluate whether board members understand the business model they supervise. Documented risk discussions in board minutes are not administrative detail. They are evidence of governance. When compliance is isolated from the board, structural weakness emerges. Governance requires informed challenge. Oversight without understanding is not protection. When governance fails, liability operates at 3 levels. First, corporate liability. The company pays fines, remediation costs, and monitoring expenses. Second, professional liability. Executives and compliance officers can face bans, license restrictions, or removal from regulated roles. Third, criminal liability. In severe cases, individuals may face personal charges. As we examined in earlier enforcement cases, regulators increasingly pursue accountability beyond the corporate entity. Ignorance is not a defense. Delegation is not insulation. If you sit in a board seat, a C-level role, or a compliance function, exposure is personal. Structure protects individuals. Weak governance exposes them. Many crypto firms rely on regulatory hosting or outsourced AML services. In early stages, this can be efficient. Execution is delegated to a licensed partner. Monitoring, onboarding, and reporting may be contractually assigned. But delegation is not the same as transfer of responsibility. Regulators assess who controls the business model, who benefits economically, and who ultimately directs operations. If core risk decisions remain internal, liability remains internal. Outsourcing can strengthen execution. It cannot outsource accountability. The key question is not whether AML is external. It is whether oversight, challenge, and decision authority remain inside the organization. Because responsibility follows control, not contracts. Technology does not eliminate compliance risk. It redistributes it. The critical question is simple: who is responsible when the screening tool fails? Compliance software produces alerts. But who validates false negatives? Who reviews threshold calibration? Who tests model performance over time? If no one inside the organization owns that responsibility, risk becomes invisible. Tools assist judgment. They do not replace governance. Vendor contracts define service levels. They do not define accountability. If the tool misses a sanctioned wallet or fails to flag suspicious activity, regulators will not ask the vendor first. They will ask the firm. Because governance requires active validation, not passive reliance. Global crypto businesses rarely operate under one regulatory regime. What is permissible in one jurisdiction may be restricted in another. A product feature approved in the European Union may face limitations in the United States. A marketing practice acceptable in one market may trigger scrutiny elsewhere. The challenge is not knowing the rules. The challenge is deciding which standard governs global operations. Without a defined decision framework, firms default to the most commercially attractive jurisdiction. That creates regulatory arbitrage risk. Mature governance structures establish a global risk committee. Conflicts are escalated, documented, and resolved at group level. Because regulatory tension is inevitable. But unmanaged tension becomes structural exposure. Every compliance structure is tested during a crisis. A regulatory inquiry. A subpoena. The appointment of an independent monitor. The question is not whether scrutiny will occur. The question is whether the organization is structurally prepared. Crisis architecture requires 3 elements. First, a predefined response protocol. Second, centralized document control. Third, direct board visibility over regulatory engagement. Improvised responses create inconsistent messaging and incomplete records. Prepared structures create controlled transparency. When enforcement arrives, speed matters. But discipline matters more. Crisis readiness is not legal strategy. It is governance design. Compliance is often viewed as friction. But mature institutions understand something different. Strong compliance significantly reduces institutional uncertainty. And reduced uncertainty lowers the cost of capital. Banks and regulators evaluate governance before committing capital or licenses. Institutional investors assess control frameworks before allocating funds. In mergers and acquisitions, compliance quality directly affects valuation. A firm with documented oversight appears investable, a firm without appears volatile. Compliance does not slow sustainable growth. It enables it. Because credibility is a strategic asset. And governance is how credibility is built. In the previous module, we discussed sanctions screening. Now consider a deeper question: is sanctions compliance embedded in your product design? A sanctions-resilient platform does more than screen at onboarding. It integrates real-time wallet monitoring and enforces geolocation controls. It restricts interaction with sanctions smart contracts. And embeds risk gating before high-exposure features go live. If sanctions controls are layered on after launch, they remain reactive. Built into infrastructure, they become preventative. Compliance is not an overlay. It is a design principle. The next enforcement cycle will not begin with missing policies. It will begin with structural weaknesses. There are 5 indicators regulators examine first. 1. Does the MLRO have direct access to the board? 2. Does compliance have documented blocking authority? 3. Is staffing calibrated to actual risk exposure? 4. Are risk discussions formally recorded at board level? 5. Is there a predefined crisis response protocol? If any of these are unclear, risk is already accumulating. Survival does not depend on perfection. It depends on structure. Because enforcement rarely surprises strong governance. It exposes weak architecture.